Okay, let's get started. Good morning. Welcome to the Greensboro chapter's October Zoom meeting. My name is Niraj Kusreshta. Please mute your microphone for the duration of the presentation. Any questions, please type it in the chat box and David will answer the question at the end of the presentation. Today's speaker is David Pinson. Today's topic is using hedging to limit risk. Thanks to AAII for support of this Zoom meeting. David started Portfolio Armor 10 years ago as a tool to help investors to hedge risk. Prior to founding Portfolio Armor, he worked in various capacities in financial services, from wholesaling at the publicly traded mutual fund company to business development at fintech startup. Now hand it over to David.
Thank you very much, Niraj, and good morning, everyone. I'm going to go ahead and share my screen and we'll start the presentation. And then, as Niraj mentioned, I'll be happy to answer any questions that you have. And okay, Niraj, you can see the presentation, I guess, right now. Everything's good?
Yes, everything is good, yes.
Okay, great. Let's get started. So the title of this presentation is Hedging to Limit Risk, but we'll go into a little bit of detail about how you can also try to generate solid returns as well. But first, let's talk about why consider hedging in the first place and what hedging is. So I put this slide in here because hedging is often used informally. People will say, for example, I bought some gold as a hedge. And for this definition, gold doesn't count as a hedge. A hedge is something that always goes up in value when an underlying security goes down in value significantly. So an example I think Niraj and I mentioned on our little warm-up call was take a stock. Take, for example, Peloton. Let's say there is, the company's been doing great, but let's say that there is a bad earnings call, for example, or any other company. There was one, I think, Fastly. I'm not even sure what they do, to be honest, but I remember it came up in the news. And this past week, I think the stock was down 30% almost. So if you own some gold and you own some Fastly shares, gold would not protect you against a decline in Fastly shares. However, if you own put options on Fastly, or that's a hedge that would go up in value when Fastly went down. Okay, and let me just make sure. Yeah, we're good. Okay, so going on to the black swans. And black swans, for those unfamiliar with the term, that came from a book by Nassim Taleb. And the idea was that I think Europeans had never seen black swans because it was all white swans in the Northern Hemisphere. And so black swan was something unusual to them. So the thing is, though, individual companies, individual stocks disappearing really isn't a black swan. According to a JP Morgan study, they looked at the Russell 3000, which comprises approximately 95%. It's the largest 95% of market capitalization of stocks out there. So it's a really wide basket of stocks. And they looked at it from 1980 to 2014. And what they found was 40% of the stocks in that index suffered catastrophic losses over that time frame. And they defined a catastrophic loss as a decline of 70% or more without recovering. So that's an example of stocks disappearing with or without a black swan. I mean, some of these, they just go out of business because there's nothing exogenous to the industry or the economy that affects them. But there are examples of black swans that hit a sector or hit the entire economy. And I've mentioned a few here. One of them, of course, everyone remembers 2008, the financial crisis. I remember at the time I was looking at Yahoo stock message boards, and there was one message that stuck with me because it was kind of humorous, because someone, I think it was in the message board for New Century Mortgage. It was a mortgage company, and someone went out for lunch or for an errand, and he came back, and the stock had just plummeted 50% or something. And he wrote, that was the most expensive quart of milk I've ever bought in my life. So the black swan there was the financial crisis and the mortgage industry blowing up and taking everything with it. Another one I mentioned on that slide here is what's happened this year with COVID-19. So if you owned restaurant stocks, if you owned real estate stocks, a lot of those industries got hammered because restaurants were closed and the restaurants were paying rent to commercial real estate investment trusts in many cases. And they, in some cases, the large restaurant chains announced that they were no longer going to pay their rent. So that's probably something a lot of us didn't anticipate at the beginning of this year, but that really devastated certain industries, including the real estate investment trusts, also cruise ships. And another one I mentioned here is antitrust action. That really hasn't happened yet, but in this past week, we've seen some intimations that it could potentially be on the horizon when it comes to technology companies. And what I'm referring to here is the controversy that came up with Twitter and Facebook suppressing the New York Post story. And some Republicans in Congress have gotten very upset about it. Whether they'll do something, I mean, I don't know. But that's something that would be a potential black swan. And that would be a reason to consider, all of these things would be reasons to consider hedging individual stocks. So we talked about hedging individual stocks. Hedging market risk means protecting against the entire market declining. And as Americans, we're used to the market recovering quickly after a market crash. We really haven't had a long bear market. Probably, we haven't had a decade or longer bear market, I believe, since the Great Depression. We've had a couple of years here and there. For example, 2000, 2002. We had a really sharp correction in 2008 and the beginning of 2009, but we had a V-shaped recovery there. And we had a sharp correction earlier this year and a recovery after that. The reason I added this slide here is because it highlights the point that that's not necessarily what will happen in the future. It is possible that markets don't always recover immediately from a large correction. And Black Rain was the name of a movie that came out in September of 1989. It starred Michael Douglas, and it was about two New York City detectives who traveled to Japan to return a fugitive, and the rest of the movie is set in Japan. It's not bad, actually. But the reason I mention it here is because since that movie came out in 1989, the Nikkei 225 has not recovered from its price in 1989. It's still underwater. So that's more than 30 years. And I'm not suggesting that's going to happen here in the United States, but it's possible. So it's something to consider, and it's a reason to hedge market risk because we're not assured that a decline in the market is going to be immediately recovered. It doesn't always happen. Now, the next question here is, if you want to protect your investments, what's the most effective way to do so? And the point I make here is the most effective way is put options. And what put options are, for those unfamiliar, it's essentially a contract that gives you the right to sell a security at a pre-specified price before a certain date. So in the example I have here, which is a screen capture from the Portfolio Armor iPhone app, the ticker symbol is SPY. That's the ETF everyone's familiar with that tracks the S&P 500. And this put option contract gives you the right to sell it at a price of $289 per share anytime before April 16th of 2021. The reason why put options work is because they give you protection even if the underlying security goes to zero. Now, that's not going to happen with SPY, but even if there is, say, a 40 or 50% decline in the index between now and April, this put option would enable you to get out with no more than a 20% loss from the price when we calculated this hedge, which was Tuesday night. And the other point I made here is non-linearity means a little goes a long way, so less drag on returns. So if you are long SPY or you're long any underlying security and you have the hedge, if the underlying security does well, the hedge is going to it's going to be worthless at expiration. So given that this is moving, the hedge is moving in the opposite direction of the underlying, if things go well, you don't want to have to put too much in here. And if you look at what I've circled in red, the cost as a percentage of position value was only 2.34%. That means you didn't put a lot of money into this hedge. You only needed to put an amount of money equal to 2.34% of your position or your portfolio to protect against a greater than 20% decline in your underlying. That's something that is a big difference between put options and, for example, an inverse ETF. Because if you bought an inverse ETF, you would probably have to put in a lot more than 2.34% to protect you against downside risk, even if it were a triple levered inverse ETF. And the more you put in that inverse ETF, the larger the drag on your performance if the underlying goes well. So to sum up, put options give you protection even if the underlying goes to zero. And relatively speaking, you only need to put a little bit in because of the non-linearity involved in options. So there is a cost when it comes to hedging, and there are a couple things you can do to limit that cost, to reduce that cost. So the first thing I mentioned here is decide how much you're willing to risk. If you're willing to risk 20%, as we did in this example, you don't need to hedge with an at-the-money put option. That's going to be more expensive than you need. So you can look at out-of-the-money puts, which is what you see in this screen capture. Because I think when this put option was created, I mean, the SPY was trading in the 300s. The next thing is you have to take into account your max drawdown, including the hedging cost. So if you only want to be down 20%, you have to make sure that when you take into account the cost of the hedge, you're not going to be down more than 20%. And that's something that our app does automatically. So if you put in, let's give an example here. If you put in a security where you only want to risk a drawdown of 20% and it costs more than 20% to hedge against that, the app isn't going to show you an optimal hedge there because there is no optimal hedge in that situation. There is in the case of SPY here. And the next bullet I mentioned was to compare annualized cost as a percentage of position value. So in this case, the annualized cost was 4.63%, but we have a drop down on the app where you can compare different time frames to expiration, and you can see if it's less expensive to do it a different way. Now, another way you can minimize cost potentially is by using collars. And with a collar, what you're doing is you're giving a potential upside to reduce the cost of hedging. So we mentioned Peloton before, and I'm using that company in this example. That's one that actually benefited from a black swan. When the gyms closed, people were looking for ways to exercise at home. And for those unfamiliar, I imagine most of you have seen the commercials, but this is a company that has exercise bikes and other equipment that you do at home, and it's connected where you can see a person coaching you, and they do classes online. So if you were looking to protect against, I think the company is up a few hundred% this year. So it's really up a lot. Let's say you wanted to limit your downside risk so you weren't going to lose more than 25% in Peloton in a worst case scenario between now and April. If you were to hedge using put options in the first part of the slide on the left, you can see the cost of that protection as a percentage of position value was a little bit over 19%. It was really expensive. However, if you were willing to hedge to limit your upside risk, you could get a less expensive hedge. And what I did in the second and third images on the slide, this is just breaking up an image that would scroll on your iPhone. So the first part, in the middle here, you see a cap of 25%. That means we're willing to give up any gains over 25% over the next 6 months. And we're protecting against the same greater than 25% downturn. And recall that we would have to pay 19% of position value with a put option. But with the optimal collar, we actually would get paid to hedge. You would collect a net credit of $950 or 7.25% of position value to hedge Peloton in this way. So the next question is, how much should you pay to hedge? How much are you up on a position that you're not willing to sell? And for other positions, is the cost of hedging greater than your expected return? So we talked about two different underlying securities so far and showed hedges for them. One is SPY, the S&P 500 index, and the other is Peloton. Now, in general, I think someone who is long Peloton from the beginning of the year might be willing to pay more to hedge than they would someone in the market index ETF. And the reason is simply they're up so much, and also they see potential for higher returns. So if you're in some kind of tech stock where you think you could do very well, maybe you would be willing to pay more to hedge that. And in contrast, if you're in a fixed income ETF, let's say you anticipate it's only going to return 5% over the next year, you probably don't want to spend 5% to hedge it, because that would eat up all of your returns. You would either maybe not hedge it because you don't think there's significant risk of it going down, or you would get out of that and try to be in an investment where the potential return is greater than your hedging cost. So we talked about hedging market risk and hedging individual securities you owned. Let's say you come into a windfall of cash. For example, you retire and you're not able to transfer the securities in your 401k to your IRA. You just get a cash distribution. You're starting from scratch. How should you approach hedging while trying to maximize your returns? Bless you. So this is a process you can go with. You start with the universe of hedgeable securities. And right now there's about 4,000 of them in the US. You estimate potential returns for them. So you figure out how well you think they might do in a bullish situation over the next 6 months. You can use a different time frame, but we tend to stick with 6 months. You calculate their hedging costs, and then you subtract the cost of hedging from their potential returns. So if there's a security, for example, you think might do as well as 20% over the next 6 months, and you calculate it would cost 5% in position value to hedge, that would be 15% in this ranking. And then you sort by potential return net of hedging cost. And then you buy and hedge a handful of names at the top of the list. So you can do this process manually. It may be a little time consuming, but this is something that our site does in an automated fashion. And I'll give you an example. The first part of it is finding names that you think are going to do well or have a good chance of doing well, but are also relatively inexpensive to hedge. So we're fully transparent on our site when it comes to performance after 6 months. And you can see that, and I'll show you on the website. For about 3 years, on average, we were outperforming the market with our security selection, and we actually started to underperform earlier this year. Partly that was just because we had shifted toward lower risk securities, and the market really outperformed from the March bottom. So it's tough to beat that. But we started to outperform again in late May following a tweak to our security selection process. And you can see a screenshot of the first cohort from May 28th that included those changes. So far, that's doing well, but you're not going to see this in the public part of the website until late November, because we only post things 6 months after we publish them, or after to subscribers. And here's an example of a hedged portfolio generated by our site at the end of last year, the day after Christmas, actually. So if you went to our site then and you said, excuse me, I have $2 million to invest. Let's say that was your 401k distribution. And I don't want to risk a decline of more than 20% over the next 6 months. In the worst case scenario, what should I do? And this is what the site would have put you in. It would have put you in both share classes of Google, K-Late, Tencor, NextEra Energy, NVIDIA, Sherwin-Williams, and Tyler Technologies. It would put roughly equal amounts in those securities at that time, because these were the securities that had the highest potential returns net of hedging cost in late December. And then what it did was it had some leftover cash from rounding each position down to a round lot, which means one divisible by 100. And it took that and put it in a tightly hedged position in Neogenomics, because that had a negative hedging cost. And that made the overall hedging cost of the portfolio lower. As you can see at the bottom here, the hedging cost was negative 1.37%. And then the next slide, we can look at how this portfolio actually did. So over the next 6 months, the green line is the portfolio, the blue line is S&P 500. The S&P was down about 3.82%. This particular portfolio was up 8.92%. And there's a number of other examples on the website. We can look at those in a moment. So putting it all together, we've got a tool that scans for optimal hedges. That's available on our website. It's also available on our iPhone app. We have a hedge portfolio construction tool that creates portfolios using the hedge portfolio method we talked about. And that's designed to not just limit your risk, but to maximize your returns. Our website is portfolioarmor.com, and I created a few coupon codes, or a few instances of it, using the coupon code Greensboro. So I'll go ahead and show you where you can enter that in on the website, and we'll take a look at a couple other things. So here's our website, portfolioarmor.com. If you wanted to join and use your coupon code, you would put the coupon code in right here. You would just type Greensboro. Okay. But while we're on the site, I mentioned the full transparency. If you go to performance and you go to top names, you can see we started out in June of 2017, and we were outperforming the market. And you can see that for 150 cohorts so far. And as you can see in the most recent one that finished April 16th, our top names were only up 1.71%, while the market was up. Yes.
We cannot see your screen.
Oh, I'm sorry. Hold on one sec. I think it went to a pause screen sharing. Okay, can you see it now? No, it's still saying it. I see. Hold on. Thanks for letting me know. Just one moment. Resume. Bear with me one moment here. All right, you can see the screen now. You can see the presentation, correct?
I'm just seeing you're putting it together slide.
Okay. What do you see? Your screen sharing is paused. And now what do you see? Do you see it now?
I still see the same thing. I don't see where you go to your website. That part is not showing up.
Okay, let me try one more time because on my screen it's showing you are screen sharing. Do you see the website now?
I still see the same slide putting it together with the coupon code.
Okay.
Try to close this presentation and then see if the screen will show up.
I'll do that. Good. How about now?
Now I see you.
Okay, do you see this? Let's see. Okay. Well,
Sorry, folks.
yeah, sorry about this, folks. We're getting this squared away momentarily. Okay, how about now?
Okay, now we see your
Okay.
website.
Yeah, sorry about that, everybody. Here's what I was demonstrating before. If you click the Join Now button and you go ahead and scroll down, you would type in where it says coupon, you would type in your coupon code here, which is just Greensboro. And then the other thing I was showing you was if you go to the Performance tab and you click Top Names, this is showing the performance of each top names cohort, of one top names cohort per week, going back to when we started tracking this publicly, which was in June of 2017. So these aren't back tests. These are things we show our subscribers at the time, the date shown, June 8th, and then 6 months later, we put the full performance on the public part of the website. So that's full transparency. And as I mentioned during the presentation, we started falling behind SPY at the beginning of around March. You can see, for example, these are unhedged performance numbers, but the market kind of roared back and our names didn't do so well. But as I also mentioned, we've been outperforming since May 28th. So this is like from the private part of the website where we have the preliminary performance. And for example, I can show you how here's like the preliminary performance of the May 28th cohort. You can see it's up 27.83 versus SPY up 15.6. And if you guys are curious what our top names are now, I can show you that too. These are our top 10 names as of Friday's close. So they included NVIDIA, SLV, the silver ETF, Tesla's in here, for example. And then while we're in here, I can show you what it looks like to use to create a hedge portfolio. So you can enter in tickers if you want to try to fit them in, but all you really need to do here, let's take 500,000 as an example. let's say you had a $500,000 cash distribution and you were unwilling to risk a decline of more than 13%. I'll put that in here. All you would do is click that submit button, and then the site would do everything else for you. And by everything else, I mean presenting you the portfolio that's designed to maximize your return while strictly limiting your risk. And here it just did it. These are the securities that it would have put you in as of yesterday's close. So you've got Carvana, Paycom, etc. And let me show you one thing that didn't show up on the presentation, which is these little plus signs. If you click on one, it expands the hedge to make it easier to see. So this is an optimal collar where you would be buying a put option and selling a call option. And then it tells you what the overall hedging cost for, well, first of all, max drawdown, if every security went to zero, you would only be down 10.48%. And then the hedging cost is 4.92%. And then this is the expected return over the next 6 months, net of hedging cost. You would be up 7.73%. Doesn't mean you will be. You might be up higher, you might be up lower, but it means that this kind of portfolio, if you kept doing this over time, your return would be kind of in that range. So that's the presentation. And let me go ahead and check and see what kind of questions you guys had. And you're also welcome to answer any question or ask any questions if you want via audio. Niraj, while I'm looking at the chat, did you have any questions yourself? Niraj?
Yes, I'm here.
Okay. So question from Lee Hayes, why do you use SPV as your benchmark? Many of your, I think it means SPY, many of your securities look like growth companies. That's a good question. We really used SPY as a benchmark just because it was a really common benchmark. But Lee's absolutely right. Our securities can vary. In fact, in some cases, they're not always even equities. I'll give you an example. Since we're still screen sharing here, I'll show you a portfolio. If you do more conservative portfolios, a lot of times you end up with non-equity securities. So, for example, let's say you went back to November of last year and you created a portfolio where you said, I'm only willing to risk a 4% decline. I'll click on show high positions. And as you can see here, most of these weren't even stocks. You had precious metals ETFs like GLD, SGOL. You had fixed income ETFs like TLT, for example. So we tracked this against SPY. Is that the best benchmark for this? No, but we're just doing it for simplicity's sake. We're doing that. And Lee had another question. How does your portfolio do in a down market? Let's go back to sharing the screen so I can show you. It's an excellent question. It really depends on the risk tolerance you use when you set it up. So, I mean, here's one example. This was started using the same example, the portfolio created in November of 2019, which means that it ended in May of this year. Is that correct? Yeah, it ended in May of this year. And this one actually did well. It was up. Bear with me just one moment, because this is up 8.46%, while SPY was down 2.9%. But another portfolio created the same date probably didn't do as well. Let's take a look. So let's look at a more aggressive portfolio from the same date. Here we go. So this is a portfolio that
David, I
was.
think your screen is frozen again.
Oh, I'm sorry. How about now?
Yeah, now it's
Okay.
good.
Okay, sorry about that. This is a portfolio that was created the same date last year, November 28th, but instead of hedging against a greater than 4% decline, it was hedged against a greater than 20% decline. And as you can see here, this one was down over the next 6 months. It was down 5.35%. So it really depends on your risk tolerance, which then drives the security selection. So in this case, remember the other one, we had a lot of fixed income securities. This one had a different mix of underlying securities in it. I'm going to jump back in the chat and see if we've got other questions here. Okay, Harry's question, suppose I join the service today, how often would I need to keep updating the portfolio? In other words, how often do your high conviction names change, monthly, quarterly? Okay, that's another great question. Our model with these portfolios is once you get into them, you hold the whole portfolio for 6 months. So you don't change that portfolio over 6 months. What you do is you hold each position for 6 months or until just before its hedge expires. In some cases, the hedge will expire in 5 months, if that's the closest hedge we got to it. But if you want to smooth out your returns, what you can do is maybe put half of your money in a portfolio now and then put another half in 3 months. And that way you'll be in 4 portfolios a year because these last 6 months each. But once you open the portfolio, you don't really need to do anything with it until you exit the positions. And another question here is, what is the optimum portfolio size? It's another good question. And what we say, basically the way we approach this is, you tell us how much money you have to invest, and the site is going to give you the optimum way to invest it. Now, the minimum dollar amount you can use is $30,000 here, but there's no maximum amount. So how things change, how the portfolio construction changes, depending on the amount of money you're investing, is really in 2 ways. One is the less money you put in, the fewer securities we're going to be able to put in the portfolio. And then the second is the less money you put in, we're going to have to restrict the securities to names that have below a certain share price. So for example, a share of Amazon right now is, I think it's over $3,000, right? Let me just check right now on my phone. If you were to create a $30,000 portfolio with us, we're not going to put Amazon in that portfolio because we couldn't put 100 shares in there. And it's too expensive to hedge if you're trying to hedge positions of less than 100 shares. Does anyone have any other questions, or you're welcome to ask them via audio if you want to, if that's okay with Niraj.
Yeah, that's fine.
How many, oh, good question from Gary Gilbert. How many categories of risk are there to choose from? The answer is you can select anything from 2% on up. So if you go to 2%, let me see if I can share the screen again and show you an example here. Can you see the screen now, Niraj?
Not yet.
Okay, just one moment. Okay, how about now?
Yes.
Okay, great. So the first category of well, you know what? Why don't we do a live version for this? We'll see exactly what it looks like. Let's say you wanted to create a hedge portfolio. Give me a dollar amount above $30,000, Niraj.
About 500,000.
Okay, so we'll try 500,000 again.
Yeah.
And then let's say you're only willing to risk 2%. Like you don't want to risk a decline more than 2% over the next 6 months. So we'll do this and we'll see what it gives us. And what I can predict to you is it's probably not going to include a lot of stocks here because there really aren't, I doubt there are any stocks really that you can hedge against a greater than 2% decline. But this is what that portfolio would look like. It's got you in a corporate bond ETF, a Vanguard Total Bond ETF. It's got you in a few currency ETFs, some short-term or medium-term treasury ETFs. And in the worst-case scenario, if all these things went to zero, you'd be down 1.98% over the next 6 months. And your hedging cost is 0.6%, and your expected return is not great. It's about 0.25% over the next 6 months, but this is going to vary with market conditions, but also the less risk you're willing to take, the lower the potential return. And going back to you can see the performance of previous portfolios hedged against greater than 2% decline. In one column, we're showing the expected return, and then the next column, we're showing the actual return. So on average, and this is over a few dozen of these, the expected return has been 0.43% over 6 months. And again, this is for portfolios you're not risking more than 2% decline over 6 months. And the average expected return has been 1.64%, and the average actual return has been 1.79%. And the benchmark here, again, SPY is not a good benchmark for this, but just for simplicity's sake, we used it everywhere here. But this gives you a rough idea. You're risking a decline of no more than 2% over 6 months, and you're getting a return on average of about 1.79%. Okay, jumping back into the chat to see if we have more questions here. Can we try? Okay, 2 questions. Lee's got a question. Do you have special portfolios? I saw a Buffett. Oh, okay. That was just something I named a portfolio. Niraj and I were speaking before. I had written for Seeking Alpha in the past. And what I did, I think the Buffett portfolio, what I did was I just took some of his top holdings and I entered in the ticker field, and then I created one. That was a few years ago. Another question here is, can we try a portfolio with a risk of 20%? And sure, let's go ahead and do that right now. So new share. Okay, so what dollar amount do we want to do this time? Well, we'll do 20% for the risk tolerance, but what does everybody want for the dollar amount? You want to stay with 500,000, Raj? Or you want to do something larger or smaller?
That's fine.
Okay, so 500,000 again. This time we'll put in 20 for 20% risk tolerance, and let's see what it gives us. Okay, so we were willing to risk 20%. Now we're back into mostly stocks. Carvana, which I think is, that's a company that lets you buy and sell cars, I think.
Yes.
At Home. Okay, At Home Inc., Paycom Software, RH, I'm not quite familiar with, CLTD, Trade Desk, and Twilio. And here Oh, this is interesting, guys. Look at this. Worst case scenario, if everything goes to zero, you're down 19.26%. So less than 20%. That's the idea. The hedging cost here is negative. It's negative 2.21%. And the expected return here is 12.96%. So how do we get a negative hedging cost? And the reason is, remember I said before what the site does is it allocates to round lots of securities. And then what it does is it takes that leftover cash and it tries to reduce the hedging cost. And it did it here by putting it in this at-home Inc. very tightly capped. It capped it with a collar of 1%. The idea is to try to get, we cap it, what we call these cash substitutes, we cap them at either the 1% or the current money market rate, whatever is higher. And we do it in accordance with your risk tolerance. So here you don't want to risk a decline of more than 20%. And the end result of that is a negative hedging cost of negative 13.32%. So that ended up wiping out the hedging cost of every other security here. So anyway, you can see the difference here. Your expected return is 12.96%. And remember, the expected return for the 2% portfolio was about, I think it was 0.26%. And let's see, let's go back to the chat and see if we've got more questions. Any other questions, guys? Does the model exclude any securities? Gary asks. The only securities it will exclude, well, let's put it this way. Its universe of securities starts with every security that has options traded on it in the U.S. So that's every stock and ETF with options traded on it. And then it starts excluding them. Here's its screening process. The first thing it's doing when we're picking the stocks and the securities is it's looking for securities that have had positive. If you take the average 6 months return over the last 10 years and the most recent 6-month return, and you take the mean of those two, we want that to be positive. So it's okay if the security's down a little bit over the last 6 months, as long as it's done well over the longer term. And similarly, if it's done poorly over the longer term, but it's done really well over the last 6 months, the algorithm will consider it. The next thing it's looking for, it's got to be able to hedge the security. And the hedging cost has to be less than the potential return it estimates for it. So it's screening those names out. So out of the 4,000 in the universe, the number of securities it ends up that make it through those two initial screens varies with market conditions, but it could be 2,000. In a really tough market, it might be only a few hundred or less. I can actually check and see. Okay, another question from Harry. Is it possible to have a portfolio mix of SPY and QQQ, say 50% or whatever, option percentage, your program decide how would it look like? Well, two things. The first thing is, if you just want to, you want SPY or QQQ, you can just hedge it directly. And I'll show you what that looks like. One second. Okay, so for example, QQQ, we talked about SPY, but let's try that. I just type in QQQ, you can type in a number of shares, and then how much you're willing to risk. Let's say you're willing to risk 23% to pick a number. Boom. We just hit that, and then here's your optimal hedge for QQQ. You can see the hedge against a greater than 23% decline. it would cost 2.27% of position value. But let's go ahead and do a hedge portfolio that includes QQQ and SPY. So what the hedge portfolio construction tool tries to do is use equal amounts of securities. And depending on the amount of money you use, it's going to vary the number. So I think it gives you about 5 securities with a $100,000 portfolio. And Gary, did you have a risk tolerance? I'm sorry, Harry, did you have a risk tolerance you wanted to try with the QQQ and SPY? Because I can enter that here. Like, what's the largest decline you're willing to risk? 15%. Okay, let's go ahead and try that. So 15, and then what we'll do is we'll enter in QQQ and SPY here. So QQQ, SPY, and then we'll go to the next screen. Now, because we entered our own securities, the site is asking us if we want to enter in our potential return estimate for those securities. If we don't, the site's going to use its own estimate. So let's go ahead and let the site do its own estimate here, and I'll click create, and we'll see what we get. Okay, in this case, it didn't include either one, and it may be because our risk tolerance was too low. So let's try one more, and we'll try to use SPY and QQQ. And you know what? Let me make a larger portfolio too, see if that was an issue. Actually, let's try it this way first. This time it included QQQ and SPY. So I'm sorry, the reason why it didn't include those securities last time was because of the share price of the securities. It was too high to include round lots of them. But you can see here, this portfolio includes some of the stocks we've seen before, Carvana, At Home, but it's got QQQ here, 200 shares of it, and it's got 100 shares of SPY here. And max drawdown is 14.13%, so we don't want to risk more than 15, and we're not. The hedging cost is 1.62%, and the expected return is 9.54%. My pleasure, Harry. Any other questions anyone has?
If there are not any more questions, let's thank David for an excellent presentation, and thank you for everything.
Yeah, and before we go, just to mention, if people come up with a question later today or tomorrow and they want to ask me, just email contact@portfolioarmor.com or go to the website and let me just go to the top of the website here and I can show you where. Here, you just hit the contact button and you can go ahead and contact me and I'll be happy to answer any questions you have.
Okay. Thank you very much, David, and we'll see you sometime in the future.
That sounds great. Thank you very much, everybody. Have a great weekend.